Your mortgage rate is around 6.66% right now. And your bank didn't choose that number. Neither did the Fed. It came from a market you've never looked at once in your life. A $145 trillion machine that quietly prices your rent, your car loan, your paycheck, and whatever retirement money you've managed to save. In 2022, that machine reached into the safe half of millions of retirement accounts and cut it by about 16% in a single year. The safe half. By the end of this video, you'll know exactly what every move in that machine costs you, in real dollars. And near the end, I'll show you one number printed on every retirement fund, a number that decides whether one rate move costs you $30,000 or $85,000. Most people never read it. Here's the plan. First, what a bond actually is takes 60 seconds, I promise. Then, the one rule that explains every crash you've ever heard about. Then, we follow one guy, Alex, and watch this market quietly reach into his pocket. Stay until the section on that hidden number, that's the part that protects your money. A bond is a loan. That's it. Someone needs money, a government, a company, a city, and rather than walking into a bank, they borrow it from people like you. You hand over a fixed amount. They promise two things back: a fixed interest payment every year called the coupon, and your full money returned on a set date called the maturity. Lend me money now. I pay you every year. You get it all back on this date. That's the whole thing. So why does it matter? Scale: the United States government borrows more than anyone on Earth. The national debt sits at $39.2 trillion. That number is so big it stops meaning anything. So try this one. The interest alone, not the debt, just the interest costs about $1.05 trillion a year. That's roughly $2.88 billion every single day. The government now spends more paying interest than it spends on national defense. And every dollar of that interest comes out of your taxes, priced by the same market that prices your mortgage. Which brings us to the one rule. The only rule. And it breaks people's brains the first time they see it. When interest rates rise, the price of existing bonds falls. When rates fall, the price of existing bonds rises. Opposite directions. Every time. No exceptions. Here's why. With real numbers. Say you buy a $1,000 bond paying 3%. It pays you $30 a year. Fine. A few months later, the government issues new bonds paying 5%. Those pay $50 a year for the same $1,000. Now you want to sell yours. Who's buying? Nobody. Not at $1,000. Why would they when the new one pays $20 more? The only way out is to cut your price down and down until your $30 a year looks competitive. At 5%, that price is about $600. Think about that. You lost nothing on paper terms. The bond still pays $30 a year, still returns $1,000 at maturity. But today, right now, your $1,000 is worth $600. Every disaster in the rest of this video is that rule. Just, bigger, and one bond matters more than all the others. The 10-year U.S. Treasury. It yields about 4.7% right now. When a bank sets your mortgage rate, it doesn't invent the number. It asks one question: why would I lend money to you for 30 years when I could lend it to the U.S. government for 10 years, risk-free, at 4.7%? Answer: it wouldn't. Unless you pay more, so the bank takes the 10-year yield and stacks roughly 2 percentage points on top the price of the risk that you lose your job, get sick, or stop paying. 10-year at 4.7. At about 2. The national average 30-year mortgage this week? 6.66%. The math is that direct. So let's watch it hit Alex. Alex is buying a house. He needs a $400,000 mortgage, 30-year fixed. At 66%, his monthly payment is $2,570. Now the 10-year Treasury rises half a point. That's routine. The bond market does that in a week. Alex's rate follows to about 7.16%. New payment, $2,704. That's $134 more every month. For 360 months, that half-point move cost Alex $48,176 over the life of the loan. A full point? Also routine. Rate goes to 7. 66%, payment hits $2,841, and that 1 point costs him $97,310. Now the part that hurts. Run Alex's same $400,000 loan through 2 real dates. January 2021, the 30-year mortgage hit an all-time low of 2.65%. Alex's payment would have been $1,612. October 2023, 33 months later, the same rate peaked at 7.79%. Same loan, same house, same Alex, $2,870 a month. The difference is $1,265 a month. Over 30 years, $455,349. $500,000. And the only thing that changed was a yield Alex never bought, in a market he's never visited. So if this market can do that to a mortgage, what did it do to the people who were told bonds were safe? For decades, the advice was simple. As you get older, move money out of stocks and into bonds. Stocks grow it, bonds protect it. The classic 60-40 portfolio, 60% stocks, 40% bonds, was sold as the sensible default. The bond half was the seatbelt. Then 2022. The Fed raised rates faster than at any point in 40 years, from near 0 to over 4% in 9 months. Apply the rule. Rates up, bond prices down. The broad U.S. bond market lost 13% that year. Worst calendar year in the index's history, back to 1976. Stocks fell 1% at the same time. So the conservative 60-40 portfolio lost about 16%. The seatbelt didn't catch anyone. It was strapped into the same crash. And the longer the bond, the worse it got. Long-dated Treasury bonds, the safest assets on Earth, lost 39.2%. One analysis out of Santa Clara University went digging through historical records and found that 2022 was the worst year for long U.S. bonds since 1754. Not 1954. 1754. The United States didn't exist yet. There were 13 colonies, and the safe part of America's retirement money was having its worst year in 268 years. Which raises the question, why did some funds lose 13% and others lose 39%? One number. The one I promised you. It's called duration. It's printed on every bond fund's fact sheet right where nobody looks. Duration tells you roughly how much your fund loses for every 1 point rise in rates. Picture a retiree with $500,000 in what she believes is a safe bond fund. If her fund's duration is 6 typical for a broad index fund, a 1 point rate rise costs her $30,000. If her duration is 17 typical for a long-dated Treasury fund, that same move costs her $85,000. Same money. Same rate move. $55,000 difference. Decided by one number she was never told to read. And here's the trap inside the trap. If you buy an individual bond and hold it to maturity, price drops along the way mean nothing. You collect every payment and get your money back. A bond fund never matures. It's a basket repriced every single day. And when rates rise, those losses land on your statement and stay there. So what do you actually do with all this? 3 moves this week with money you already have. Move 1. Check where your cash sleeps. The average savings account in America pays 0.38%. 3-month Treasury bills pay about 3.7%. High-yield savings accounts around 4.2%. All 3 same safety, insured or government-backed. Say you've got $50,000 parked at a big bank. At 0.38%, that earns $190 a year. In T-bills, $1,850. That's 9 times the money and over 5 years. Leaving it at the bank quietly costs you $8,300. Same risk. Different address. Move 2. If any of your retirement money sits in bond funds, find the duration on the fact sheet. Takes 2 minutes. Above 7, your fund moves hard when rates move. Above 15, it behaves like a volatile stock wearing a safety vest. Move 3. Learn one habit. Glance at the 10-year Treasury yield. 5 seconds to look up. When it climbs, mortgages and car loans climb with it. When it drops fast, the bond market is bracing for trouble and it has a scary track record. An inverted yield curve has come before all 10 U.S. recessions since 1955. 10 for 10. It's the closest thing the economy has to a check engine light. And now you know how to read it. So back to that number from the start, the 66% on your mortgage. You know where it comes from now. Not your bank, not the Fed. A $145 trillion machine humming in the background of every dollar you'll ever earn, borrow, or save. The people who understand it aren't smarter than you. They just stop pretending it was boring. If this connected some dots, hit like so it reaches the next person who's never looked at this market. Subscribe if you want the math on the next one, and watch the video on screen next, because it covers where the Fed actually fits into all of this. See you there.